All right, let's get started. Hi, everybody. Thank you so much for joining us today. We're going to talk about taxes. Taxes are so exciting. I've never heard anybody say, but boy, I wish I could pay more taxes. So we're going to take a dive into this topic because, no matter what, it does affect us. All right, so before we dive in, I just want to quickly introduce ourselves. I'm Kelly Olczak. I'm the managing partner of LynnLeigh Company. We are very proud to be a 100% woman-owned registered investment advisory. We're located here in the Bushnells Basin outside of Rochester, New York, and we manage the finances for a handful of families in our community. As fiduciaries, we are committed to putting your best interest first. Even if you're not working with us, we have to. I am a certified financial planner. I have held that designation since 2009, and I'm always really passionate about helping people turn their financial goals into their reality. Joining us today is our operations manager, Chaz Miller. She's going to be moderating for us today, and she will help us. If you've got questions, please feel free to use the chat function, and she'll let us know what questions you might have. So feel free to chime in. Joining us today also is my partner, Becky Gillette. She is our dedicated Chief Compliance Officer. And very few firms of our size actually have a full-time Chief Compliance Officer. Becky's focus is solely on compliance and operations. We're super fortunate to have her help us keep a watchful eye, making sure everything runs smoothly. At LynnLeigh, we always believe that informed clients make better investors, and that's why we're here today. So I really hope that you guys will join us in questions so that we can make sure that we are hitting the mark. Why is that not going? Okay, so normally we will have a handful of questions at the very beginning of our session so that we keep them out of the way, but today's topic is quite detailed, so we're going to launch the first poll just to get us started. Thanks, Chaz. So if you guys could do us a favor and just let us know what your thoughts are, it'd be super helpful so we know we're keeping track of what you guys are hoping to learn today.
I'll let
Right.
that go a couple more seconds, Cal, and then I will share the results.
Awesome. Thanks, everybody, for taking just a couple minutes for this. Okay. Thank you for that. Is that so, Chaz? I see things differently than you do. Have you shared the answers?
I did.
Okay, good. Awesome. Okay, let's move forward. So this is one of the most important and quite honestly common questions that I hear. Am I paying more than I should? Not just at tax time, but all year long. Tax planning is something that we use to help our clients with financial planning. Now, we're not giving tax advice. It's mostly trying to find out, missed opportunities. The truth is many people are missing opportunities, not just because they're doing anything wrong, because they're not looking at the long-term strategy. And especially right now, this time of year, we're getting our taxes ready for the year, for last year. But I'm confident that our job as private wealth managers is to help people pay the lowest amount of taxes across the lifetime, not just in the year that we're in. And because tax planning isn't just about paying less, it's about building more flexibility, more control, more wealth. how to keep that as low impact on your taxes as possible. If you've ever felt unsure about whether you're using the right accounts or taking income the right way or timing things well, you're not alone and you're in the right place. Because I hope at the end of this session, you'll have a much clearer understanding of the smart moves that you might be able to use and how to align them with your financial goals across your lifetime. So we're going to cover some topics here, and please remember, we're going to share ideas with you. Not all of them will apply to you, and certainly you want to talk to your tax preparer before you do anything. We're just going to give you some ideas. Okay. So here are the topics we're going to cover today. I forgot to turn that off. Okay, so let's move forward. Chaz, if you could push out the next one, that would be great. Thanks, guys. I know Jason Curtis is not going to participate because he knows everything. Well, not really, but he's. Thank you. I'm teasing you, Jay. I did participate. Kelly's busted. Thank you, Jason.
Thanks.
Okay, so
I'm going to
let's
end
move.
that, Cal,
Yep,
and I'll share if you'd like.
please. That'd be great. I did participate. Sorry, Jason.
And that was a 50-50 split.
Yeah, no kidding. I'm a good boy. 5 gold stars, Jay. Okay, so to make smart tax decisions, the first step is understanding how tax brackets work. So we have a progressive tax system in the US. This means that your entire income isn't taxed at just one rate. And instead, different portions are taxed depending on the brackets you fall into. So I find that sharing stories with clients we've worked with in the past helps. Of course, her name's not Mary Ann, but this is something that at the end of the workshop, and if you have feedback on what ways that I could improve on sharing these complex situations, that would be super helpful. Also, remember, you might know, this is recorded. So if we cover something and you want to come back to it after we're done, you're going to get an email saying, thanks for participating. If you want to rewatch it, here's how you do it. So we're going to talk about our friend Mary Ann. She has a consulting business. She makes $100,000 a year. Unfortunately, she was widowed. She's got about $650,000 in retirement and really wants to retire in 3 years. So she is trying to understand how to reduce taxes now and in retirement. Of course, everybody at this stage in their lives has questions around Medicare and long-term care. I find that people are really worried about outliving their money. And of course, that means they want to avoid overpaying and making smart use of tax breaks. So you might think that because Mary is making $100,000, that she's going to pay 22% on all of it. So that is not true. We're going to walk through this. So Mary files single and she's a widow, and that gives her a little extra. So these numbers are for 2025 standard deductions. So right off the top, she takes $14,700 away from her earned income. Mind you, you guys, this is very high level. We're not talking about the fact that she may have made contributions to a retirement plan, but this is plain vanilla C. Jane run kind of stuff. So her taxable income ends up being $85,300. So what does she really pay? There are slices. Okay, so the first set of dollars from $0 to 11,600 11,600 is taxed at 10%. Then the next chunk is at 12. And then the final portion, which is about 47,000, is taxed at 22. And so her total tax would be $13,587. So her tax bracket is 22%. That's called her marginal tax rate. But her effective tax rate is 13.84%. Shockingly, 13.84% is less than 22. So smart tax planning isn't just about staying out of the higher tax bracket. It's about consistently lowering that effective rate over time. So high level, here are just the things around understanding tax brackets. And then we have one more poll. After this, there are only two more. But this tax bracket thing is super important. Awesome. Thank you, guys.
And I just shared those, Cal. Those came in really quick.
Awesome. Okay, let's get to the fun part. As I mentioned before, the goal of tax planning is to optimize your income so you pay only what you owe and not more. So again, here's Mary Ann, and she's really looking forward to spending time with her kids and traveling. And she does have other questions, so here are some of them. And these are real questions our clients are asking us. Awesome. Okay. So we're going to talk about some short-term tax planning decisions. So she's going to retire in 2026. 2025 becomes a critical tax year for her for a number of reasons. We've got, oh, did you have questions, Jason? No, sorry. Okay. So there is a tax code that was pushed out by the first Trump administration called the Tax Cuts and Jobs Act. And that may or may not sunset this year. We're going to assume it does. And what that means is higher tax rates, different types of standard deductions. So Mary Ann's going to make some decisions based on what we know now. Okay, so let's walk through two of her main options and why one decision could shape her future pretty well going into future years. So two primary strategies: reduce taxable income through deductions and pre-tax contributions, strategically timing income and deductions to stay in that lower bracket. And with this uncertainty of the Tax Cut and Jobs Act, you'll see it TCJA maybe if you're doing homework. But if that sunsets, we need to take planning steps for the future. So the best approach depends on your current bracket, future income expectations, and financial goals. So that's why this is sort of a very high level situation. But I think telling a story kind of helps folks understand what might apply to them. For many people in her situation, using their long-term last working years through Roth conversions could ripple and make a strategic win for you in the long term. So the other thing I want you to know is not every decision is the easiest to make right now. It's more about the long-term planning. And I've got a great illustration at the end of this which will help you understand that. Especially around Roth conversions, because it may come to a short-term cost with regard to taxes, but it will help you or could help you with avoiding other pitfalls later. Okay, so here's one more question. So I lied, there's one more, and then we've got a lot. Okay, good. Don't really understand how it works. That is great. Thank you for that feedback. All right, let's go. Okay, so we talked a little bit about how Mary can manage her money in the short term. And now we're going to dig into how to align the tax strategies with your financial goals. So if we're going to do a Roth conversion, it's not just about checking a box. So this slide really does help you kind of look at what things Mary was thinking about when we did this for her. We're not just trying to do a Roth conversion for the sake of doing a Roth conversion. We're thinking about where to draw dollars from in retirement, not just to minimize taxes for the short term, but we really are trying to avoid surprises later. And we intentionally designed her asset locations so she has the right kind of money available and the right kind of accounts. When we built out Mary's retirement income strategy, we didn't just think about which funds are the top performers. We start to look at each account and how it fits bigger into her goals. There are three types of core account type. Sorry, there are three core account types, and each one has a different purpose in her retirement picture. Okay, so her Roth. This is her long game account. This is where we're placing investments so that if she has an expense above and beyond her everyday expenses, she can take money out of that account without a taxable event. Roths do not have required minimum distributions or RMDs. So that means that she doesn't have to take money out if she doesn't want to. So if she wanted to buy a car and needs some extra money to pay cash for it, the Roth makes a great decision. Is a good place to start for that. And the other thing is if she wants to leave money to her grandchildren, Roth inherited Roths are tax-free to her beneficiaries. So her IRA, this account is all about reliability and predictability. Um, I've had a couple clients that brought this up to me. They didn't realize, like they've been putting money in their 401ks or their IRAs forever. They didn't remember that those dollars have never been taxed before. And when you hit a certain age, right now, for most people, it's 73. For some of us that are younger, it's now 75, believe it or not. But when you hit those ages, the government makes you take money out. And that's where we're coming at this from a planning perspective. So we're using this account for steady taxable income when the time is right, ideally in years where her income sources are lower, but not always. It also is a place that if you're worried about Medicaid, your IRA is protected from Medicaid. Medicare is for regular health insurance and retirement. Medicaid is when you need critical care. And Medicaid cannot make you spend down your IRA. So, or your Roth, by the way. So that's important consideration in the future also. Now, Marianne also has a brokerage account. Oh, I got it. I shrunk. Oh, I hate it when I have a typo like that. Sorry. Brokerage accounts. Those are investments that you've already paid taxes on. Um, Meaning let's say you put $100,000 in that over time and you've paid taxes on $80,000 of it. So if you have to take money out, most of those dollars have been taxed already. So it's very efficient. The benefit is you never have to, you do not get forced to take money out of your brokerage accounts. However, those accounts might be affected if you need Medicaid. So as a lifetime goal, the real power comes into how to coordinate all three instead of viewing them in isolation. So yes, tax planning really, really matters because it gave Mary Ann freedom, peace of mind, and the ability to say yes to moments that count, like she wanted to take her kids on a trip without having taking money out of her IRA on purpose. Okay, so why this works for her? It's important for her values. She wants to travel. She wants to see her kids. She sees taxes as a tool, but not the reason we make decisions. Okay, that's also very important. It allows her to have flexibility in her income stream. When she pulls the right levers at the right time, she might not need to pay taxes. And it really does allow her to focus on things that matter most. So tax strategy should not live in a vacuum. It works best when we coordinate those retirement accounts, her income needs, and her legacy wishes. Okay, so we're going to look at how a smart tax plan can be used intentionally. Use your portfolio intentionally to reduce your tax bill without changing your overall investment strategy. Okay, so unlike her IRA or Roth, she has to pay taxes on that brokerage account every year. And we're going to illustrate a concept called tax loss harvesting. So, as I mentioned earlier, Mary Ann's IRA dollars, those have never been taxed. Mary Ann's Roth dollars have been taxed, and those dollars, when they come out, won't be taxed again, even if it grows. So both her IRA and her Roth has what's called tax-deferred growth. But when you have a brokerage account, you're going to pay taxes every year on dividends and interest, even if you reinvested those, meaning you never took them out. And that's what changes the amount of dollars that have been taxed in that brokerage account. So one year, Mary Ann had she had a position that had done very well, but she also had an investment or a couple of them that weren't doing so hot. So rebalancing is so key to making sure your investment strategy long-term works for you. And in this case, we sold some of the investment that was doing really, really well. We didn't sell all of it, but we did experience a $7,000 long-term capital gain. At the same time, we sold about $5,000 of investments that were underperforming. By taking the loss, she turned the losing position into a tax win. And so it offset the gains and even reduced her regular income. So how do you do that? So she took the long-term gain and she subtracted the long-term loss. Math is pretty simple, right? 7 minus 5. And she only paid taxes on that $2,000 difference. That's pretty spiffy. So she was also able, with the gain, to leverage $3,000. So she was able to reduce her income by $3,000. The gain and then the rest of it she was able to carry forward. So here's a kind of hopefully a neat illustration of what we do for our clients. So I do like it when the market's bad sometimes because we can cherry pick losses and put the losses against a gain. So that's kind of what this infographic is illustrating. And again, this is something I would love to hear feedback on. In Mary Ann's situation, that $3,000 that she was able to deduct against her earned income, that's real money. And it really helps her in the future. Okay, so we're going to say, how does it help you in the future? We call this the ripple effect. So it's the idea that a single tax smart decision today doesn't just save you money now. It can create a series of positive outcomes in the future. So instead of thinking about tax strategies like in isolation, we're going to look at how they interact across income, healthcare, retirement, and even Mary Ann's legacy goals. It's kind of like a skipping stone across a lake. Okay, so we talked about Roth conversions. When Mary Ann converted $30,000 from her IRA to her Roth IRA, she was still working. And yeah, she did pay taxes in that year. But that decision was not random, it was intentional. She knew that tax rates were probably going to change in 2026. So instead of waiting, she paid the higher taxes now and took control of timing. So what did that do? It lowered her future required minimum distributions. So we took the $30,000 out, we paid the taxes on it, we rolled it into a Roth, and the proceeds after tax went into a Roth and continued to grow tax-free. At the same time, later on, her RMD is going to be smaller. It also meant that she was lowering her adjusted gross income in retirement. And that becomes really important when we talk about Medicare costs and staying under what's called IRMA. We call IRMA, IRMMA, and that is income. Oh gosh, I always get this stuck. My cheat sheet's gone. Please hold. I'll get back to that. So IRMA is an extra charge added to your Medicare premium. Chaz, can you do me a favor and look up what IRMMA is? So we are an RIA, and the people that work for us are IARs, and we have clients that have IRAs. So I'm wondering why I forgot what IRMAA means. Sorry. Okay, so what IRMA is, it's an extra charge if you make too much money. So which I don't know anybody says they make too much money, but there's a limit. And if your income is too high, you have to pay a little extra, and that's the IRMMA. And here's the catch.
Cal, that's
Go ahead.
income-related monthly adjustment amount.
Thank you. Say that one more time.
Income-related monthly adjustment amount. That's a mouthful.
Yes. So the more you make, the more you pay for Medicare. And Medicare looks back for this charge. It looks 2 years back. So what you earn this year will affect you 2 years from now. So if you are single and you made over $103,000 in retirement or right before retirement, or if you filed jointly, that's $206,000, you're likely to pay more in Medicare. And that's why working through this for Mary Ann was very helpful, because we not only saved her taxes, earned like income taxes, but also this Medicare tax too. In the Roth account. So again, we mentioned that this is where her source of tax-free income can be, but it gives her which does give her flexibility in retirement, but also allows her to take money out when she needs it without bumping her into a higher tax bracket, and it will not affect IRMMA. So yeah, she did pay a little bit more taxes this year, but it gave her more options in the future. And that's really what we're trying to accomplish, these trade-offs. So by doing this, we saved her money. We didn't just save her money in the future, but we kept that IRMA down and gave her more flexibility. And by the way, we're not trying to beat the system. We're just trying to make sure that she doesn't leave money on the table if she can avoid it. So here's a really quick checklist of the things that we did with her, and why it mattered. Any questions so far? I know we're covering a lot of technical stuff, but trying to make it simple. Okay. So let's shift. Thank you very much. Thanks, everybody. That's helpful. Okay. So that is the very high level details that we've given you. We can always dig in deeper. We've got some really helpful handouts because everybody's journey is their own. As I mentioned before, these decisions are dependent on who you are and what you need, but they should not be made in a vacuum. They are interconnected, and the timing does matter. So if you're already in retirement, some of this might not have help, but it might, because maybe your tax bracket's lower. That's a question for your tax preparer. To help you take the next steps with clarity, these are some handouts that we have for you. When the session is over, you'll get an email with these handouts. I hope they're timely. Yeah, so that is our presentation. I've got one more question for you before we leave, and then if you have questions and answers, we've got a little extra time. Awesome. Thank you, guys. Thank you for all your participation. So I would be happy to answer any questions you have. If you want to talk one-on-one, obviously be happy to help. Even if you're not a client, you just want some feedback, we'd be happy to help you. We have walked through this with clients many times. That's why I like doing these sessions with stories, because I think they're more relatable than, oh my God, tax is so riveting. But I hope it did spark some questions or gave you a little bit more clarity. So Jason's question is, does it make sense to go over IRMA in the interest of conversions? And help me understand that just a little bit more, Jay. Oh, and yes, working in conjunction with the attorney or with a tax preparer, because IRMA is predicated on your earned income in retirement and also 2 years before retirement. So it is something that you would want to know about. So I didn't know about IRMA at all until I took a tax planning course. And a lot of people didn't have any problem with it before retirement, and then they get into retirement, and I mean, it's like 4.6%. And it's nice just to have an understanding that at least you know about it. Like, I do like surprises, like, wow, I found $10,000, instead of, uh-oh, well, I now owe more money. Yeah, and it does sneak up on folks for sure. I can actually put together a little spreadsheet or a little handout for IRMA and add that to our discussion, so I can follow up with everybody and send them up an IRMA handout also. That's a very good idea. It literally took me 6 weeks to create this slide deck. I can't believe I got this done in 40 minutes. Overthinking it. But it's nice to see a lot of you guys here. Oh, Nancy, good question. So good question. Does IRMA only affect those younger than 70? Okay, so if IRMA is all about Medicare. Okay, so it'll start affecting you if you are using Medicare to cover your healthcare expenses. And it will, thanks, Cyril. It will affect you throughout your entire retirement. So it's all about Medicare and the taxes. So how do I explain this? If you are in retirement and your income, if you're single and making more than $103,000, then it will affect you in retirement. Or if you're married, filing jointly, 206,000. So yes, Nancy, thanks for that question. And yes, Earl, I do overthink everything. You should know that by now. Any other questions? Any questions about Roth conversions? Well, okay, everybody. Tim, it was nice to see you joining us again. Nancy, I hope Pennsylvania's doing well. Hope you guys are getting warmer weather. Norm, I haven't seen you in ages. Thanks for joining us. Jay, thanks for inviting him. Oh, Q&A is turned off. Oh, Tim, good question. Use the chat function. We did turn it off because it means we got to pay attention to one more thing. Sure. What's a Roth, a backdoor Roth? Very, very good question. So, a backdoor Roth, we typically use that with folks that make too much money to do a traditional contribution to the Roth. And so what we do, depending on the individual, is, let me give you an example. So I have a husband and wife, they're both physicians. They do not have IRAs. They have 403Bs at work. They make a lot of money, and every year they make a contribution to what's called a contributory IRA. Okay, so they put $7,000 in the IRA. Then the day after that money hits that account, we move it to the Roth. It's weird. They can't just put it in the Roth. It's got to go into an IRA first, traditional IRA, pre-tax dollars, and then converts to Roth. Okay. And because they do not have any IRAs, there's no taxable event there. I don't know why, but that's how it works. If they had an IRA and they converted it, a proportion of that contribution would be taxable. Oh, and using real estate and rentals to accelerate depreciation to offset W-2 taxes, please. Nah, I love you, Tim. I'm glad you think I'm that smart. That's above my pay grade. So let me just ask a clarifying question. So real estate investments or rental income? Boy, that is way above my pay grade. I can't answer that. I'm sorry. Sometimes I'm an advisor that can't give advice. What I can tell you is, Tim, if you were a client of ours, what we do, we have really great relationships with our client CPAs because we can help model in our wealth management and financial planning tools so we can illustrate something like that to a CPA with their guidance on how that would work for your individual perspective. Because they're the people that really understand your deductions, and if you've got real estate, properties, and rental income, that accelerated depreciation is really what I don't want to touch. So, but I'm always one to learn. So thank you for that question. Now, the other thing to know, this is kind of a little off mark, but let's say you have an employer-sponsored retirement account. Okay, this is all about reducing income across time before retirement. Let's say you've got a 401k at work and you have a real LLC that's generating income, another job. So as an example, my husband, he worked at L3 Harris, but also had a consulting business in optics, and he worked with GE. So he had the 401k with L3 Harris, but he had his own SEP IRA where he had earned income from GE at the time. And he was able to max out both of the plans because they did not count on each other. Like he could max out the 401k, and the rules allowed him to also max out a SEP. So Tim, just off the cuff, if you have a property where you are the actually not passive income, a SEP IRA may help you reduce more of your income in the year. I don't know if that's helpful or not. Thank you very much. Anybody else? Well, guys, I think that's all we have for today. Please, please, please feel free to reach out to us. Even if you're not a client, we can help answer questions or point you in the right direction. When we finish this workshop, you're going to get a survey, and I'd really appreciate any feedback, maybe some topics you'd like us to cover, maybe going into Roth conversions, stuff like that. We really try and keep this low jargony, high education, kind of CJ and run things. So that would be wonderful. Thanks, everybody. I hope you have a great week. It's going to be rainy for the weekend, but we're moving in the right direction. Bye now.